Hello, everyone. This is Ted Bauman here, editor of the Bauman Letter, with your Monday Your Money Matters video. It's one of those times when nobody quite knows what's going on in the stock market, up and down, up and down. But one thing that we have got a lot of people talking about recently is what does it mean to anticipate a double bottom? Because that's one of the things we've talked about a couple of times in videos recently, some of them extremely popular, by the way. Thank you very much for watching. A double bottom simply means that we expect that the stock market will go down again. And the important thing is that that does not mean we don't think you should be trading stocks. In fact, we think the opposite. The whole point of talking about a double bottom in the stock market is to wait for that deeper discount to buy stocks so that you can get bigger gains. I want to show you a chart that illustrates why this can be so important. This chart shows the period between mid-2007 to the end of 2010 in the aftermath of the financial crisis. As you can see, some people might have been tempted to buy in late summer, or sell in late summer at that time when the stock market was on a slow trend down. Then some people might have panicked and sold when the stock market hit that very low point. Some people might have sold at the very bottom. Now, those people made a terrible mistake, but the smart people would have done the opposite. They would have said, well, stocks have gone down. This is an opportunity for me to buy. The question is when. So on this chart, you can see that if you bought at the end of the summer going into fall, you would have really only broken even at the end of 2010. If you bought in that October period after the collapse of Lehman Brothers and Bear Stearns, then absolutely you would have made a lot more, but waiting for that double bottom would have got you the biggest gain. So that's the reason why we think it's important to understand the double bottom. It's not that we don't want you to buy it, we just want you to buy at the best discount. Now, what that has raised, though, is the fact that a lot of people recognize this, maybe because they're listening to our videos, Clint, but basically people have decided that this is an opportunity to get ready to buy stocks for the first time. And here's a chart that shows the people who are Googling, how do I buy stocks? It's just skyrocketed recently. So essentially what we then got is a situation where people have learned an important lesson from the 2008 crisis. It's not the end of the world. Instead, it's an opportunity to buy a dip and make lots of money. Now, Clint, we're going to talk today about how to go about investing in stocks. You've been an investment manager for a long time. Things that are second nature to you and to I are not necessarily the case to other people. How does one go about buying stocks? Walk us through the process in the simplest possible way. Where do you start? What are the steps? And then we'll talk about more details.
Yeah, sure. So I guess step one, if you're considering this, is choosing a brokerage. There's certainly no shortage of choices these days. I know over the last several years now, there's a lot of app-based platforms that become popular, names like Robinhood. They kind of popularized the zero commission form of investing, which is great for saving costs. But I would, for just starting out, I would steer clear of those app-based platforms. I would look at some of the larger discount brokerages that are out there for a couple reasons. One is that they've also caught up to the zero commission investing platform. So companies like TD Ameritrade, Fidelity, Schwab also now offer zero commission stock trading. But the other thing is that these large discount brokerages, they've got plenty of access to support, both in form of personnel and educational materials. From a support standpoint, if you're in the middle of trying to execute a trade and something's going on that you're not sure about, it's comforting and reassuring to be able to hop on the phone and talk to someone on the other end to be able to help you out. Right. Some of the app-based platforms are also going through some growing pains, I think. We had a couple of days back in March where Robinhood was experiencing some outages. So if you have a brokerage account, you want to be able to access your brokerage account, and that's another reason to look at some of these larger names out there.
Right, and you mentioned Robinhood's problems. I mean, that was a big deal. Basically, people who wanted to sell on a particular day couldn't get access to their brokerage accounts on Robinhood because the apps had crashed. Same thing happened when people wanted to buy. So there's a pretty good reason to have a proper online brokerage account with a reputable company. But of course, some can be in your retirement account, some can be not in your retirement account. The ones in your retirement account, those brokerages come from the money that you put aside every month that goes into your retirement account. Now, what a lot of people don't know is that even if your money is being deducted by your employer and put into a 401k, you can often end up being able to trade that portion of that money yourself by setting up a tradable portion of your 401k. So if you have a brokerage with, or rather an account with a big retirement fund manager like Fidelity or somebody like that, consider maybe setting up a brokerage account that way with part of your retirement funds. Otherwise, you can set up a brokerage outside, and that's what Clint's talking about, something that is a trade account that is not protected from tax. It's not something where you can grow your money without tax. You will pay capital gains, but there are two ways to go about it. All right, let's say that you've got money in a brokerage account, Clint. You've either got it from the money that has put in from your retirement funding, deducted from your paycheck, or you put money into an account yourself. What's the first thing you see when you open up your brokerage account?
Well, the next thing you have to determine then is the account type that you want to open. So the most basic type out there is just an individual account. You own the account, you make the decisions, you make the trades, you're the one authorized to move money in and out of the account. From there, if you want to own that account with someone else, you could set up a joint account. That someone else could be your spouse, it could be a friend, a relative, it could be a group of people. The important thing to note under the joint setup is that whoever else you go in with has the same legal rights to that account. So make sure it is someone you trust. If you want the feature of someone else being able to access the account to help you manage, whether it's making trades or moving money in and out, but you don't want them to have the same legal rights, you could designate a power of attorney. Basically, that's going to authorize someone to be able to go in and do things on your behalf, but then it's easy to remove that power of attorney as well if you no longer want that person on your account.
Right. So you've set up the account. You've decided whether you want to do it individually or with somebody else. For example, power of attorney. I know a lot of people have their accountants have power of attorney or their lawyers. Now, what happens when you got money in the account? Let's say you want to buy some stocks. What are you going to see in that account? What are you going to do?
Yeah, from that point, it's going to come down to the order type that you want to use. Now, the two main types of orders are market orders and limit orders. Part of the decision using it is going to be liquidity. That's basically how much of the underlying stock is being traded in the market at any given time. But a market order basically means that your order is going to execute, but you cannot ensure the price you're going to get. For highly liquid stocks, yeah, you're going to get close to the prevailing price that you see on your screen. But for less liquid stocks, you might want to consider using a limit order, because a limit order allows you to specify the price that you want to receive. Now, the risk is that the stock doesn't trade to that price and your order doesn't execute. That's the trade-off between the two.
So let me just illustrate with an example from something that I do, when I trade. So I go in, I type in, there's a little form that'll say here is where you put in the ticker. Let's say I want to buy Apple, AAPL. I put it in there. That's a highly liquid stock. People are trading millions of shares every day. So at that point, I can just take a market order, because the bid price that people are willing to pay for it and the ask price are very close. But if I want to buy a less liquid stock, a small cap, or maybe some ADR, which is a foreign stock that trades on the American exchanges, I'm going to see a big gap between what people are willing to pay for that stock and what people are asking for it. So the limit order gives me the opportunity to say, I will pay this, but no more. And then hopefully somebody will come along and accept that price. And that's important, isn't it, Clint? Because basically that's how you lock in gains. It can be a huge difference. You can make 3 or 4% more over time on your holdings if you use that limit order. Now, we do have, folks, an essay or a guide, if you like, on our website that describes in detail how all this stuff works. So we're not going to talk about it all here. The critical thing is that this is not something to be afraid of, and we want you to be ready to do this when the time comes. Now, Clint, the same thing operates in reverse when you sell, right? If you're going to sell a stock, you also have to look at the difference between what people are willing to sell it at and what they're willing to buy it at, and choose whether to use a market order or a limit order. But what about if you just want to be protected, if you want some insurance and you can't look at your portfolio every day, but you want to make sure that you don't end up seeing a steep discount or decline in the stock? Is there a technique we can use there?
Yeah, so once you actually have a position, if you want to limit the losses you could potentially incur, you could use a stop order. A stop order is just specifying a price that you would sell at below where you purchased at. So let's say you bought a stock for $50 a share, and you don't want to see that position go against you by more than 10%. So you would go in and you put in a stop order in at 45. Now what that does is once the stock hits 45, that stop order automatically becomes a market order and it's transacted. So you're guaranteed to get out of your position, but what you can't guarantee is the execution price you're going to receive. But just like with our limit order example, you can also put in a stop limit. So if you put in a stop limit at 45, what that means is once the $45 level is triggered, then that order becomes a limit order to sell at 45. It won't sell unless it can get $45 or better on the execution.
Right, and that's something that we sometimes use, but the important thing to remember about limit orders is that they're not always appropriate for stocks that are volatile, and they're not, often can get you into trouble in a situation like we saw earlier this year, where stocks fell all of a sudden over a short period of time for no good reason other than the fear of the virus going through the economy, through the stock markets. They have rebounded. So people, if they had done that, would have been stopped out of their positions. They'd have to buy them again. But there's an alternative, I think, and that is a trailing stop. We talk about that in our How to Trade guide on the Bauman Letter website. And that's essentially a situation where you say, well, whatever price peak that this stock reaches, if it falls below a certain percentage below that peak, then sell. And that's often something that you do with more volatile stocks. Now, we've talked a little bit about the types of brokerages to use, what you see when you go into the website. And the key thing is this is not difficult. This is really an easy thing to do. What about how to allocate money across, if you're just buying stocks? Let's say you've got $50,000 to spend, you want to buy 10 stocks. So how do you go about it? Do you buy according to the stock or according to how much you have to spend?
Yeah, so I think a lot of people initially think about buying based on a share amount, where they just want to go in and they want to buy 100 shares of all the stocks on their list. But the problem is that stocks trade at different prices. 100 shares is going to mean a different dollar amount for each stock. So what you should do in your example of a $50,000 account, to have some money management rules in place, to allocate properly, don't risk any more than 5 to 10% of your account on any one position. So in that example, that means you should not invest more than $2,500 up to $5,000 into any one position, and to do so on that dollar basis. Take that dollar amount, then divide it by the share price, and that's how many shares you should own of that particular position.
Right, and of course, that is very important because a lot of people instinctively think, well, I'll buy 100 shares of this and 100 shares of that. But, Amazon trades for thousands of dollars. So if you bought 100 shares of that, you've spent all your money. Other stocks trade at, less than $10. So 100 shares is nothing. So really, it's about maintaining an equal weighting in dollar terms. So, for example, in the mock portfolios that I use to track the Bauman Letter and the Alpha Stock Alert, I start out with an initial allocation of $1,000. I divide that by the current stock price, and that's how many I put in as the mock allocation. And that way I can track the relative performance in dollar terms of our particular investments. Now, folks, that's the basics of how to open an account. It really isn't difficult. It just depends on setting one up, applying to open one if you don't already have one, or opening up one within your retirement broker. Now, some of these accounts allow you to trade for practice before you actually get to start trading yourself. They allow you to run a model portfolio to get used to the idea, and that's something that I recommend highly. If your broker allows that, you don't actually have to put real money on the table at risk. You just check it out, see how it works. Once you've done that, you can see how you would do with your own money. Once you feel comfortable, do it. But remember, the key thing here is that you want to prepare yourself to be able to do this kind of trading when the stock market starts to return. So now, if you're not already set up with a brokerage and teaching yourself how to use it, learning from resources like those on our website, then the thing to do is to start doing it now so you can take advantage. Remember, in addition to stock trading specific recommendations, we also do have resources like this in the Bauman Letter as part of your subscription. And that's why I would encourage you to look at the text below this video, see if it makes sense to you to want to become part of the Bauman Letter family. And in addition to getting stock picks from us, learn how to do it. So that's it from us this week. We are continuing to monitor the markets. Friday, when we're recording this, looks like a flat day. Disappointment over the lack of results from the Gilead coronavirus vaccine test, et cetera, lots of things. It's all about headlines for the time being, folks, which means that the market's going to be volatile. And now is the time to prepare yourself for the dip that we see coming. Clint, thank you very much. We will talk to you again next week.